Ajay Shrivastava joins us. Let's take a conversation forward with him. Ajay, lots to talk about. What should we start with? TCS numbers, the drop in bond yields?
I think the wonderful way to start around is that the FOMO is dead. You know, people who are fearing that they will never get to buy stocks, it is all going up. This correction, or little bit of correction, whatever we call it, whether it's in commodity stock, whether it's in steel stocks, I think they are giving an opportunity to get in again for the investors who got left out. So to us, the predominant theme to investors is, never feel sad that you left the market and its share price has rocketed past. You will get a time, and time has come for some of the sectors are getting re-rated downward for the interim for whatever reason, but you get a chance to buy. To me, the most important thing for investors is to make them understand that, when you feel left out, market gets you a chance to get back in. That's one. Number two is keep your powder dry. So many IPOs, so many new kind of companies. This is going to change the dynamic, whether it's LIC, whether it is Zomato, whether it is, the number of companies coming in the gig space. I think you got to start allocating capital to that. So investors need to keep some money in the bank for those IPOs. So FOMO dead and IPO ahoy.
Are you hinting at buying Zomato? Because if I look at Zomato, it in a sense dismisses all the basic and historical parameters of valuation.
Of course, we were discussing in another channel day for yesterday, I think a day before, the fact that, the first paradigm is to buy negative EBITDA companies. I think that's the bottom line, right? That's what you're alluding to, that how do you buy, how do you value these companies? And I agree with you that there is no paradigm in corporate finance textbook which explains this phenomenon. What explains the phenomenon is companies like Amazon, which were negative for like God knows what decade, and they give you a phenomenal return. What's the key here is, I think, whatever we like it or not like it, that we do not know. We know one thing: the future belongs to some of these companies. Now, whether we are valuing them correctly or not, I don't think any genius can say that. And we profess market has never been the genius on that part. But you can't not have a portfolio of gig stocks for Indian economy. I think to stick to the old brick and mortar would be, I think, just the way IT came. When IT came in, there was some lot of things about IT, and look at the way the performance has been for IT companies. Infosys struggled at 10, 20 rupees for almost more than a decade. And when it shot up, it went up to wherever. So I think it's not about EBITDA. I think it's about being in a sector of economy which we think has a great future. Now, whether we value it right or wrong, that's why I said you may get a chance to buy Zomato maybe again at 50 rupees or 40 rupees. I don't know that answer. But I certainly believe that not being in gig economy is worse than staying out of it.
Okay, fair enough, Ajay. Hi there, good morning. Let's get back to the traditional sectors like auto, two-wheelers in specific. Do you think the fact that these fresh lockdowns could spell more trouble for two-wheeler stocks? How are you looking at them placed on a price-earnings multiple?
I think two-wheeler stocks are good stocks. They will run their course. They have run their course. They've done remarkably well for the last year and a half, 2 years. They will take a breather, and then they will pick up in the next leg, I think, the post-October season. So if you're a buyer in these stocks, you got to be patient with these stocks for two reasons. One, these stocks spew out a lot of cash for you. You look at the dividend of whether Bajaj Auto or Hero or whatever TVS, the dividends are very, very good for these stocks. They don't go and delving in other businesses like some other companies. So, focus yourself on two-wheeler, not as a short-term story and saying what's going to happen to offtake in the next month or so. Focus on the fact that 4 companies in India, or 5 at best, will control this market or Indian market for the next decade or so. And there is no doubt about it that 70% of India still is deprived of basic products like a scooter, motorcycle, etc., etc. So it's a longer term story, but you got to stick to it. If you're going to play a speculative story, I think the returns are going to be mediocre till the next 6 months.
Analysts are trimming, albeit very slightly, the EPS estimates for TCS post its numbers. What is your view? Are you confident that going forward, the strong demand, the kind of position that TCS holds, will hold it in good stead in the long haul?
200%. I think it's not only TCS, all the IT sector. You will have a bad quarter. Every company in the world will have a bad quarter. But that's where the time when you start to get in if you don't have TCS. And it's been a story of a compounding of a nature, not only TCS, Infosys, now Wipro has got steam ahead. HCL Tech has disappointed. But I'm just saying, look at this basket of IT companies and you see the performance of them over a period of 5, 7, 10 years. And tell me one reason why when India starts to pick up digitization, the whole of Africa, Europe has lagged behind quite substantially. Today, most of our Indian companies are what, 70-75% US market. If the rest of the world kind of starts to get in, and I'm saying that, for example, like what happened in HDFC bank technology fiasco, the banking industry, rest of the world, has spent next to nothing on technology compared to US. So it's again, long-term story. This is for very good investors who want to keep it. These are Nestle investors, I call them, which means buy, lock, keep, add. That's the only story. There is never a sell which should come in this game.
Ajay, where do you think is scope for a surprise this earnings quarter, especially for a market which is at the elevated levels that it's at? We've seen a beautiful recovery and rebound since the start of the pandemic last year up until now. Do you think more than upgrades, the scope for downgrades perhaps may be higher because of the over-ownership and the elevated levels in the markets?
Well, I think downgrade I don't think will happen in too many numbers in companies, because for the reason that we all know that this quarter is going to be subdued for the physical performance. Whether it is steel, cement, everyone, nobody could supply for 45 days. So there is no way not that the performance is going to be lower. But I think downgrades happen in a much longer perspective and a trajectory of performance, which means the fact that they foresee that the next 9 months or so, and that's what downgrades focus upon, this trajectory of collapse of demand for that 45 days or 2 months will continue. And I do not think so. And number two is most of the old candidates, the regular ones who were up for the downgrades, have deleveraged the balance sheet. To that extent, the risk has also gone down in the system. So in this year, we believe as a company that we will see more upgrades than downgrades, because the management focuses on two things. You talk to any company, working capital management and debt reduction. No one is wanting to go and borrow majorly. People are absolutely clamping down on working capital. Costs have been brought down to the level unseen before. So I do not think that there will be many sectors for a downgrade, even post this result, although results will be mediocre, we all know it. So that fear is not there. I think the fear in the market is that with the number of IPOs coming in, with the number of LIC IPOs going to come in the very soon, the large IPOs, is there enough domestic liquidity to take on both buy domestic stocks as well as IPOs? My guess is will be a shift from not buying stocks, other available stocks, or selling some of them to move to IPOs and new companies. And that could be the churn. Investors need to figure it out which company they're going to do rather than worrying about downgrades. I guess so. That's what's going to happen.
You're convinced that we are in for an earnings upgrade cycle. Now, what happens this quarter could be a interplay between commodity prices and yield. It could be interplay between FI buying or DI selling or vice versa. Give me 3 stocks where you say, it doesn't matter to me, it's a 10% downside, it's a 15% volatility. I'm very clear that a 15-20% earnings growth is there for next 2-3 years, and a 15-20% P multiple is also going to happen. So what I'm trying to understand from you is that where will you look through the noise and the clutter and the near-term weakness in the price?
I'll give an example for this. And we hold that for disclosure purposes, and we're not recommending it, please. Like CDSL. Now, the depository stock, now everyone needs to hold a depository account between 2 companies in India. No matter which way we run it, if there's an LIC IPO, if there's so many new IPOs coming in, and if the buzz is that they will offer it to the existing LIC policy holders, at least 100 shares or 200 shares each, you can imagine how many crores of new accounts to be opened. So there is this company now with a clear trajectory running with the market. Doesn't matter where market goes. A company like CDSL will anyway have accounts. People will trade in this thing. They'll make money on depository charges. And therefore, you have a company very clearly de-linked from the market. Doesn't matter. It gains from expansion of capital market. So that's one company, I'll quote as an example. Then there's another company called IEX, where we have again a holding for disclosure purposes, which is directly linked to the power sector. The more it trades and the more it goes into the exchange trade, today almost less than 10 or 12% goes through exchange trade. They are normally 1-to-1 contracts. Now, more and more contracts of power go into the IEX trade, and it's a sole monopoly today. They're trying to build a second one, but that's very small. So therefore, it doesn't matter where the industry goes, where the market goes, what happens. The volume in that exchange, and once they have the subsidiary gas exchange also coming up, which acquires volumes, you can imagine it doesn't matter where the market goes. The power is a shift from one to one into an exchange concept, spot, 1 day forward, etc., and they expand to gas. That company's got an amazing expansion. So I'm just giving you two examples that which have nothing to do with the what happens to market tomorrow, consumer demand, but have a natural trajectory of growth, and they will keep growing as the market formalizes and expansion of capital market happens. And on the power side, power deregulation happens.
Ajay, I'm asking this question, we've discussed this point in the past also. People are buying steel stocks because steel prices are going higher. But China is such a large swing factor in steel that nobody knows how to understand it. Today I was reading a report in the morning which talks about how the Chinese are changing goalpost every week. 3 months ago they wanted to bring the price down. Now they're saying that the new growth cycle has unleashed. What is going on there?
Well, if you talk to the steel guys, they think it couldn't have been better for us, because what's happening with the volatility is they're getting good pricing for the longer term contracts. And I think for a lot of people, understand that more than 70-75% of sales of steel companies is by long term contract, is not on spot basis. So spot movement has very limited impact, some impact, but very limited impact on the financial. I think the longer term impact is the long term contract, what they do with auto companies, consumer durable companies, and infrastructure, of course, is on a project to project. So that's kind of literally like close to spot. You have to look at steel sector from one perspective. What happened to the cement sector? Cement sector went exactly through the same process. Too many players, high leverage, and look at where the sector got re-rated and where the P's are today, where the valuation multiple is today. All said and done, the steel sector today is the lowest, cheapest price sector in the whole Indian economy. You have absolutely no example of any company with EBITDA multiples of 5, 7, or less than 8 kind of stuff, huge free cash flow.
Management of DC